From the morning reading, oil down, stocks pull back. Cores, MAT, Google, gap up. RCL, ADT, PBI, HRS, gap down. One of 9 sectors moved higher on Tuesday. XLU, XLB, and XLP were the strongest sectors, while XLE was again the weakest sector. Oil fell $1.78 to close at 29.54. Breadth weakened as decliners led advancers 3.97 to 1 on the New York Stock Exchange and 3.83 to 1 on the NASDAQ. The ratings firms are starting to really pile on to the energy companies. On Tuesday, S&P downgraded another 10 energy companies. Over the past month, those downgrades have spiked to a 20-year record high. Typically, when there are big, sudden jumps in the number of credit downgrades, an industry is going through its final death throes before substantial rallies. Investors have been so uncertain in recent days that most sessions have been all or nothing. For the last 7 days, had 85% of volume flowing to one side or the other. Over the past 6 months, a remarkable 29 days have seen that, one of the highest totals since the S&P became 500 stocks in 1957. Utilities continue to hold up, with more and more extremes beginning to trigger. 100% of the stocks in the XLU fund are now trading above their 10-day and 50-day averages. That is the first time since April of 2014. According to the seasonality tables, February is the worst month for XLU than any of the other ETFs that is commonly followed. Seasonality is a minor factor in stocks, but it's curious timing given the extreme optimism and breadth in XLU. And then also in seasonality, let's talk about the January effect. This is the historical indication of where the S&P 500 is likely heading for the balance of the calendar year based on what transpired during the month of January. With all the January precincts reporting, the month has closed. The January loss stood at 5.07%. Out of 66 years since 1950, this places January 2016 in 59th place amongst those 66 Januaries. In a study where you break January performance into 4 quartiles, the upper quartile of Januaries in terms of monthly performance ranges from 13.18% down to 4.1%. The average January gain for the upper quartile is 6.81%. The average balance of the year gain for those top Januaries is 17.51%. That's an impressive number considering that the S&P 500 had such great numbers in January. The stock market went on to provide huge gains during the balance of the year, not including those stellar January results. When you break down the 4 quartiles for average January performance followed by the average balance of year returns, the second quartile averaged up 2.81% for January with a follow-on for the rest of the year of 9.75%. In the third quartile, you were down 0.72% with a follow-on for the rest of the year of a fairly flat 1.27%. And then on the fourth quartile, with average January being down about 5.21%, or about the same performance as what you had with this current January, the rest of the year was also a flat, relatively flat, plus 2.3%. The above performance suggests clearly that strong January performance tends to lead to strong balance of the year performance, while weak January performances leave little hope for the balance of the year. January 2016 fell 5.07%, placing it squarely in that bottom quartile. The fourth quartile January performance is comprised of the worst 16 Januaries since 1950. In those 16 years, we have seen double-digit gains over the balance of the year 4 times, or about 25% probability. To compare, however, consider that the upper quartile, the best 17 January since 1950, we have seen double-digit gains over the balance of the year 14 times, with 2 other years returning 9% and 7%. There was only one year, the 1987 crash, where we saw an upper quartile January followed by the balance of the year decline. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:35 a.m. Central Time, and I'm recording this in preparation for the market day of February the 3rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. There was a pretty good amount there of morning reading, but I thought all those items were pretty interesting, so hopefully you found that as well. In the overnight, as of the time of this cut right now, we're slightly up. We were down pretty good amount in the early overnight, but that rallied and then fell back from the highs of that rally to come into where we are right now. So it's a little bit of all over the place. But at this time, the S&P futures are up about 1/3%. Russell futures are up just above scratch, as are the NASDAQ futures. The Dow futures are up about 1/4%. Crude oil's up about 1.87%. Interesting that crude oil could be up, closing in on 2%, and the broad market doesn't seem to be responding anywhere near as robust. When you look at the euro, it's up just over scratch. Bonds are down just below scratch, and gold is up just above scratch. In overseas action, China is down about 1/3%. Hong Kong down big, 2.3%. Japan down very large, over 3%. You have Germany down over 1%, and the United Kingdom down about 0.5%. In terms of macroeconomic reports for today, you have the usual crude oil inventories report during market hours, as well as ISM non-manufacturing and the ADP non-farm employment change. Obviously, the big employment monthly report is coming out on this Friday. Let's see if there's anything else for the U.S. I don't see anything else for today. So it looks like much of that is during market hours today, so be aware of that with your trading. In terms of tomorrow and looking forward for the U.S., we see the weekly variety of unemployment claims, non-farm productivity, unit labor costs, and factory orders month over month, as well as for you nat gas traders, the natural gas storage report. In terms of current volatility, we certainly have seen a lot of volatility in terms of price action of late, often to just kind of end up right back where it came from, and that certainly is the case yesterday. We were down 1 standard deviation moves or greater in all 4 of the U.S. indices. You see the IV percentiles, though, relatively low. 33 on the S&P still, 42 on the Russell, 39 on the NASDAQ, and 41 on the Dow. Short-term VIX at 22.19, so certainly it's elevated, but nowhere near as high as it's been. Also notice that the skew is relatively low at this point. See here. Let's go on to the charts. Let's go ahead and use the futures since we've had so much action of late. And you see what I was talking about with the overnight. You had quite a little dip at the beginning, and then it rallied all the way up to about 1909, and then now has come down off those highs. So right now, the overnight candle is a bit of a spinning top, and it's slightly above yesterday's close. So nothing terribly concerning at this point. Obviously, we still have almost 2 hours to go before the market opens. Now let's take a closer look at this action from yesterday, and you notice that we had the big breakout of the range, about 5-day range there, big breakout, significant follow through from the reversal candle, breakout of the diagonal resistance at this point, but then settled into a range, but then breakout on the news from the Bank of Japan about negative interest rates, on Friday, but this was then met by a doji, and then that doji, which could have been just consolidation and then continuation, but was indeed then met with a reversal, which reversed much of the candle we had here from Friday. Didn't come down all the way and close below that, but did close back into the prior range. So this could be seen as a potential setup as a bear flag, or it could be seen as a bull flag in a very short-term pattern. It's not the best setup for a bull flag in that it certainly came quite a bit of ways down this big body. If it had come down half the body or less, that would have been much more reasonable for the bull's case. You could make a case both ways. Today's action will certainly be of interest to see if this is a follow through and continued breakdown. And certainly in the next couple, 3 days, we'll have a lot more clarity on this. But this certainly brings into question, a number of factors. One of the things that with this breakout and this action here on the SPX, let's go to that chart. With this action here, we had gone to market phase 2, and which is an improvement over phase 1 for sure, which is where you are certainly looking for bear flags. But then with this action of yesterday, we deteriorated, retrograded right back to phase 1. So that's not a good sign for the bulls. And we've got a number of key support areas down here that we're going to be watching should they come into play. The first one being, a break of the bottom of this Friday candle. That would be pretty significant. And if that happened, you certainly would expect that we would see action bringing you back down towards the bottom part of this range, probably down to the 1850 area. So that'd be your second line of support. And then your third line of support down here at the swing bottoms around this 1812 using the SPX. So think of that as 3 lines of support. This is the first one. That's a big warning sign if you get a close below this 1894 area on the SPX, and then a break of this range about 1875, and then a break down into the 1812 area. Continual breaks of any of those 3, increases the odds of a more serious outcome proportionally. Now, let's put a little bit of caveat on this. This is just a giant range that goes back some period of time, and the fact that action comes down into this area doesn't necessarily mean that we're going to go and break out of the bottom of this and totally break down. It's still inside a range where price has even been, in relative recent terms. So that we would have, a pullback into this area and then a sideways pattern develop, or even some other pattern develop that doesn't give us an outcome of a full out bear market is absolutely possible. So we'll have to watch, and we'll evaluate the increasing risk conditions as these things develop. Of course, we could see that none of that develops, and we could see that this just simply reverses and then resumes this kind of short-term pattern of a more bullish pattern. In terms of the Russell, also a lot of nullification yesterday of the bullishness from Friday. NDX the same, and Dow very much the same. Couple things that are of interest, though, if you look at volatility, so far volatility, including coming into this today, is up. So that would seem to say that there is an increase in hedging going on by the institutions, a little bit more fear premium being placed. So that's not a benign signal at all. Also, when we look at bonds, bonds had a huge move yesterday and broke out of what was kind of a quadruple resistance zone. So strong breakout move by bonds. There's talk of bonds going up into this 166 plus area easily, perhaps even past that into the 169 area when you start doing some of these patterns and measured moves. So if that happens, that also is not a good sign for the equity market, and the bond traders are considered some of the smartest traders in the world. When you look at TLT, you see this pattern again, and look at that. It had a big gap, big body, and close above the prior resistance. So many people would consider this an overhead breakout, and would be looking at this as an entry signal to actually go long at this point on TLT. Near-term target would likely be this 132 and change area, and that's a pretty big move. And if that happens, it's probably because equities are also rolling down. Other areas I'm keeping an eye on, look at this, utilities. Big move by utilities, and you heard in the morning reading some references to utilities, and look at this, closed just below the intraday high, and that intraday high was right at the prior swing high. So this is right up on resistance at this point, but certainly if bonds and other components continue to break up, we'll see the utilities go right through this area and could be running back up towards the 52-week highs up here in the 49 area. So that's pretty big moves in a sector that is very defensive, and a sector that is considered to be normally pretty staid, but that certainly is not the case at this time. And then we have consumer staples has also been making a big move from those recent swing bottoms, and has not seen that kind of consolidation pattern, has not seen the pullback to the same kind of relative degree. It's up above the cloud, very bullish short-term pattern. Again, another very defensive area. So that's probably enough on the charts today. I spent a lot of time on the morning reading and the charts today, so we're going to move right through the daily guide. Notice, still says phase 1 here. This should be back 2. It should be back to a 1. We did change that. And note, in terms of the portfolio investor posture, we still have these mixed signals, a confirmed uptrend, bullish, coming from IBD, but at the same time, the accumulation distribution score in the S&P, pretty lousy D, NASDAQ a D+, though I will say that those are improvements over the E's that were there. GMI index still is 0 out of 6. Stock charts decision points, we see some improvements. You've seen, these PMO signals have come in with green arrows on the short term in all four, so that is a slight improvement there. Overall consensus between these systems is that we're a market in transition, and you could certainly make a case that we could be bullish or bearish coming out of these patterns. In general, there's a lot of red still here, but some real hope for the bulls as well. Intermediate term market posture, we could call it bullish, as it technically has not turned negative, but it was dead flat. So basically, we should call this neutral. And then that combined with the very bearish sentiment line would mean that the expectation is that any bearish moves would be more pronounced, more significant than expected bull moves. And you see right here, only the S&P with that neutral setup, the same score as the day before. All the other indices turned down slightly, but still the mechanical signals say bearish once you turn negative. So that is of some significance. Probably not too much, though. We'll probably at this point should just simply call this whole thing neutral, and that would probably be the best description. As a neutral status, and with the other information, I left the hedge warning status at level 1. Yesterday's action was not great, but at this point is not the end yet. and I didn't see a cause to raise that hedge warning status quite yet. So hedge warning status, of course, means that there is some elevated risk level in the market, being at level 1, kind of our yellow light, as it were. We don't want to just be stomping on the gas as those cars in front of us are getting ready to stop. At the same time, it is certainly a situation where it's not a healthy bull market. We saw some of our warnings come back into play. Market in decline, sharp increase warning, VIX futures up over 18. We have already, with the recent reset of this count, 2 distribution days on both the S&P and the NASDAQ. That's not a warning level yet, but it's pretty quick to be already adding up that many distribution days. Current week out expected move is still elevated at 55. And we have now 3 of the 5 intermarket risk aversion indicators flagging as risk off. Fear and greed index at 24. And in terms of special opinions, I'm calling the covered call and the put selling borderline acceptable to initiate new positions for novice traders. So be defensive, and you've got a number of suggestions here just how to be defensive in setting those new positions up should you choose to set that up. In terms of sector specific, you can see quite a bit of red came in here yesterday, and look at what's holding up the best: consumer staples and utilities, those defensive sectors that we talked about with the charts. Percent change, what's only green across these different time frames? Utilities, and including yesterday. So that again is telling to the market. So we've gone over my self-imposed 20-minute limit. A lot happening and very important action here, but we're not going to spend any time on the slides here today. I'll scroll through them. If you'd like to see something in more depth, just hit the pause button and hit the hyperlink and go there for more information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and note the hyperlink that takes you to the full set of disclaimers. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.